In the 2026 business landscape, regional leaders are constantly told that AI-driven analytics will automatically cure their operational inefficiencies. Executives often respond by purchasing expensive software suites, expecting the new system to autonomously reconcile their disconnected records and repair years of systemic neglect the moment it's installed. But just months later, those same companies are often left with ghost town dashboards, high-end visual tools that look impressive but sit entirely unused by the staff. This failure rarely stems from poor graphic design. It is the result of a total breakdown in trust. When stakeholders see unverified or conflicting numbers on a screen, they stop believing the tool. Once that trust fractures, the team reverts to gut-feel decision-making, running the company on intuition while the expensive new software runs in the background. Without a verified foundation, the investment becomes a digital paperweight, an asset that consumes your budget while providing no actual insight for the business. To find the root of the problem, we have to look beneath the software interface and examine the hidden structural chaos of the company's data architecture. Most mid-market firms suffer from an Excel epidemic, where the most critical parts of the business are managed outside of official systems. Essential business logic becomes trapped in fragile, isolated spreadsheets. This creates massive operational silos. Your Salesforce CRM tracks leads, but without talking to QuickBooks accounting, you can't see the full customer lifecycle. This lack of connective tissue makes decision intelligence impossible. When you deploy AI onto this fractured architecture, the system cannot decipher the mess. Instead, it generates confident hallucinations, inaccurate forecasts that can lead to massive financial miscalculations. Running AI on dirty data creates a hidden tax on your growth, often costing more in capital and manual correction time than the old processes you are trying to replace. Beyond the technical hurdles, many SME executives vastly underestimate the actual capital required to make their data actionable. This is the rule of 3x. For every dollar spent on software, budget 3 times that for implementation. That covers services, training, and data governance. Then comes the talent crisis. Most firms can't afford a $150,000 data engineer just to maintain these systems. Trying to fix a broken data foundation using the traditional enterprise model of high-priced talent and complex software is simply not a sustainable financial path for a mid-sized firm. To succeed, you have to stop looking for a software fix and start implementing a systematic, clean data strategy. This begins with a framework like the match methodology, which audits your existing systems to ensure that your tech stack actually aligns with your team's technical capabilities, rather than overwhelming them. For non-technical teams, the focus should be on low-code or no-code platforms that prioritize accessibility and clarity over enterprise-grade complexity. The goal is to bridge the gap between your messy source data, like your ERP or CRM, and human-verified insights that your team actually trusts. Once the foundation is clean, you can shift from historical reporting, which only tells you what happened, to predictive sales analytics, which helps you see what is coming next. By automating your data flow, you transform the entire operation. You move from spending 40 hours a week manually cleaning and correcting data to spending just 40 minutes acting on it. AI-ready data is something you build, not something you buy. By fixing the foundation, you turn your data chaos into a tool that allows your business to operate with precision and speed.